this next session, we look to understand shadow capital and how it is growing in Southeast Asia. Shadow capital refers to the practice of institutional investors, family offices, and sovereign wealth funds deploying their capital alongside private equity funds. This is unlike the traditional practice of placing capital in the hands of a fund manager to invest on their behalf. Here to present on this trend is Bain & Company's Alex, partner, and Suvir, senior advisor, global private equity. Let's go over to the presenting duo from Bain & Company, Alex and Suvir.
Well, hello everyone. My colleague Alex and I are excited to share highlights of our recently published report on investing trends in Southeast Asia with you, with a particular focus on shadow capital. In the next few moments, we'll touch on three things. Number one, what happened in the industry at large in 2019 and why, in our view, shadow capital is taking an increasingly prominent role. We'll look at what's happened closer to home in 2020 and the implications as we move ahead. And we'll zero in on a few specific themes and the implications of shadow capital. Our overall conclusions from the report are that fund managers are going to need to be more agile and adjust to the new paradigms in the industry. Let's start first by looking back at what happened in investing in Southeast Asia in 2019. Over the last several years, we've seen that the deployment of capital in this part of the world has remained above 10 billion or so. Last year was about 12 billion. The proportion of deals that happened, the largest deals in the industry, above $1 billion, was slightly less, at about a third of the deals. Average deal value came down to about $100 million, accounted for largely by the uptick in smaller deals done predominantly in the technology sector. In terms of geographies, Singapore, as always, remains an important central fulcrum for deal activity in the region. But what's been very interesting is to note the increasing uptick in deal flow in Indonesia and Vietnam. And over the last 5 years, the growth in deals in those markets has been higher than elsewhere in the region. One of the things we talked about in our report at this forum last year was the emergence of the tech ecosystem and startups. And it's very interesting to see that the investor landscape in Southeast Asia is seeding more than 300 startups a year, with more than 100 of them getting into subsequent rounds of funding. That points to a very healthy startup ecosystem in this part of the world. Many of those have gone on to achieve unicorn status, billion-dollar valuations, some much more than that. And in fact, we're saying that the top 15 or 16 account for 130 billion. Those numbers keep changing. I think with the recent stock market activity and the growth in valuations of companies like C, the number is even higher today. But perhaps what's even more interesting is what's behind these unicorns, is the emergence of the next wave of future unicorns in the industry. And here we've just profiled the next 20 that are getting a substantial amount of funding on their path to achieving unicorn status for some of them in the years ahead. Now, the title of the report is Shadow Capital. What exactly do we mean by shadow capital and what's happening here? Shadow capital is in fact the funds that are being deployed in the industry that are not counted in structurally set up numbers in typical fund structures. So effectively, they're not coming from PE funds themselves. They're coming from institutional investors, pensions, sovereign wealth funds, the direct arms of corporate VC, and so on and so forth. And this is accretive to, or adding to the money that's going in directly by those GPs. these entities have a substantial amount of money to deploy. They are deploying it in themes that they are most focused on. They are deploying it in many cases with patience. In other words, they're not looking for short-term exits. And that's why some of the capital demand is for these long-term investors. We can see that they're accounting for a substantial portion of activity. Last year, they participated, shadow capital participated in 60% of the deal activity in Southeast Asia. Now, that was a look back a little bit at 2019. Let's turn our attention to what we've seen happen this year in light of COVID and the expected impact that COVID had on the investment market in Southeast Asia. So first of all, given the economic uncertainties that COVID created earlier this year, one would have expected, and we saw, that deal activity ground to a halt. To date, there's about $5 or $6 billion of activity that's happened in Southeast Asia. That's well off the 10 billion plus that I said up front has been the steady state investment pace over the last few years. Now, even with an uptick in Q4, I don't think we're going to end anywhere near the levels of activity we've seen in the past year. Some of the notable underlying trends behind this, though, have been that much of the shortfall has been due to the contraction of mega deals being happening. In fact, the number of smaller mid-sized deals has been very resilient, with only about a 10% drop in activity in these smaller deals in the industry. Sectoral-wise, technology has definitely been hot, and sectors enabling the e-commerce boom in Southeast Asia, like logistics or payments, have also been quite significant in terms of their activity. Now, the industry is obviously measured not only by the money that goes in, but also the increase in value of those companies and ultimately the exits, the recycling of that capital to generate true alpha for the LPs or the capital providers. And as you'd expect with the economic uncertainty, 2020 has not been a good year for exits. And based on Q3 data, we saw a very substantial decline in the level of exit activity in Southeast Asia, just over $1 billion. In fact, most of that was accounted for really by one transaction. Now, in the last few weeks, we have seen a few other deals be exited, but I think we're probably going to end the year at $2 to $3 billion in exit activity. When you have 12 or 13 billion going in, but only 2 or 3 billion coming out, as you can imagine, that creates a significant need for funds to focus on realizing value and exiting the companies that they have invested in. To put some data behind that, we see that today there are almost 160 companies held in the portfolios of private equity funds in the region that, in our view, need to be brought to the market in the near future. In the short term, that creates some pressure on IRRs for these firms as they seek appropriate avenues to exit this capital. With that, let me hand over to my colleague, Alex.
Thank you, Suvir. So, appreciate that. I think with that being said, let's now move on to the In Focus segment of our Southeast Asia Private Equity Report for 2020. And this In Focus segment focuses specifically on shadow capital, the role that it's been played within the region, but also on the impact that it's had on talent models and the changing talent environment. Now, our collective Bain view here is that shadow capital is bringing tremendous value to the Southeast Asia investing landscape. Excuse me. There are a few reasons for this, and the first of which is that we fundamentally believe that there are a lot of opportunities, as many of you will know, to deploy capital to invest behind companies and themes in Southeast Asia. But many of those investment opportunities are extremely long dated, that require very deep J-curves, that require forward-thinking investments in platforms, truly building something that generates alpha. Now, shadow capital investors, they don't have the types of stringent requirements in terms of when they deploy, how quickly they need to deploy. They're not tied to the success of their individual funds in the way that their fund manager peers might be. And so as a result, they can take a much more evergreen and longer-term view of investing in this region. And so that's something that this region sorely needs as we think about unlocking the next wave of growth and opportunity. Now, the second point is that shadow capital is providing a level of stability and resilience to the market that urgently needs it in the face of a COVID crisis. And many of the investment opportunities that are coming to market during this time, indeed many of the startups that have a fundamentally strong business model, that have a tremendous long-term growth trajectory and opportunity, but because of the COVID crisis, because of the impending needs in terms of deploying investment in opportunities. For instance, e-commerce spiked up during the crisis. Teleconsults with doctors spiked up. Many of those models are still burning cash as they grow, and so they've needed capital to deploy throughout these cycles. And shadow capital has been a stabilizing force that continues to invest behind long-term opportunities and long-term trends. And the third point is that shadow capital investors, because of their long-term view, because of their heft, they're able to truly disrupt their own investing space. They're able to push activism on the portfolio management side, but also in terms of new investing capabilities and trends when it comes to driving ESG and responsibility within their portfolio. Now, on the flip side, you could say that there is a price to pay, and it's typically been borne by their competing or peer fund managers. In many situations, they are partnering with fund managers on deals, but in many, they're also competing directly for assets. Our recent survey of investors in Southeast Asia revealed that about 30% of those investors were kept up at night, were facing sleepless nights based on the thought of their shadow capital competitors. And on top of that, just the fact that many of these sovereign investors in particular are building up strong teams in Singapore and Malaysia, very deep teams, that's creating pressure for investing talent and competition for investing talent as well. Moving on, just to give you a sense for how shadow capital investors are deploying throughout 2020, the deployment pace has been almost metronomic in the way that they have deployed in assets across sectors throughout the space, not just in Southeast Asia, but also in Asia Pacific at large. And as you can see through some of the names on this page, some of the deployments, and I should mention that this could be in co-investment with GPs, with private equity fund manager investors, or it could be direct investments as well. But you can see the types of sectors they're investing in here: financial service, fintech, e-commerce, the surrounding logistical ecosystems, healthcare, many of the sectors that have been facing headwinds and structural challenges in terms of what could be deployed, but tremendous tailwinds in terms of the longer-term acceleration to their full potential that's been accelerated through the COVID crisis. Now, when you take that shadow capital lens and you look at what's happening really with GPs and how they've been building out capability, how investors and sovereign wealth fund investors and institutional investors have been building out their talent base, Southeast Asia has always been a talent-constrained market when it comes to private equity investing, and it's not because of a lack of talent or individuals, but merely because there is not 20, 30 years of huge amounts of deployment pace and expertise and talent that's been built up through that local market expertise that you can hire. In many cases, it's been brought in, it's been grown up through large funds and so on. And so it was already a pinch point. And indeed, up to 1 in 4 of the investors that we surveyed were finding that it was causing them sleepless nights as well. But what's interesting is we speak to many of the MDs, the private equity partners in this market. We're hearing that they're investing their talent strategies have been changing. Their operating models have been changing. They've been hiring a lot more people with data analytics capabilities. They've been hiring people with ESG responsibilities as part of their titles. They've been extending their virtual expertise and virtual scale by networking in experts and advisors that have very specific and deep industry expertise so that they can continue to add value and bring value in the face of a highly changing and dynamic environment. Now, when you double-click on some of the big investors in this space and you really have a look at how they've been hiring, a few interesting trends jump out. Now, at Bain & Company, we do a lot of commercial diligence work and support for our private equity clients, and that involves looking at an asset for a potential investment for our clients, evaluating whether or not it can grow and truly achieve some of the full potential planning that is being envisioned by that investor. And so one of the tools that we use for that is Bain's proprietary Aura platform, where we're able to double-click on the talent systems or the talent framework, individuals that's in place within these companies and how that's shifting over time. And so that enables us to see just how their employee base has shifted, where there might be gaps in their talent model, and so on. Now, what we did was we turned that tool not just on the assets that are being invested in, but we turned it back on the investors to have a look at how their business models are evolving, and we found something quite interesting. So as we looked at 3 specific investors that operate quite heavily in Southeast Asia and Asia Pacific, we looked at one sovereign wealth fund with over $400 billion of assets under management, over 1,000 employees globally, but based in Southeast Asia. We looked at 2 global buyout funds, one of which had over $100 billion of AUM globally and more than 100 investment professionals in Asia Pacific, and another with high amounts of AUM and many people inside Asia as well. And interestingly, what we found was that the number of new talent type individuals, individuals with data analytics titles, with software engineering, cybersecurity, and other sort of data and analytics related capabilities. The number of people per $10 billion of AUM had been growing massively, and that had been led by the sovereign wealth fund in general. So as a reading example on this page, for every $10 billion of AUM, this particular sovereign wealth fund had 2 individuals that were hired that had these diverse skill sets or titles in their team. And that was interestingly up about 4-fold since 5 years ago. So there's clearly an understanding that these new talent models, these new capabilities are absolutely critical as they think about really capturing the opportunity and deploying in the best way. And then as you look at the way that they're just leading the way versus some of these global funds that are massively accelerating in terms of that new talent capability and headcount within their organizations, going from 0.2 to 0.7 headcount per $10 billion AUM, we really feel like the sovereign investors and the institutional investors are making great inroads into disrupting their own space. And I think that leads to quite a bit of an excitement going forward as well in terms of what can be done and how they continue to generate alpha. So when we step back, as I mentioned, we fundamentally believe that shadow capital is a very welcome and stabilizing force in Southeast Asia. And that's for a number of reasons. Fundamentally, they invest throughout cycles into GPs, into private companies, and into startups, and they provide a deep source of patient equity capital and debt capital. They are blue-chip investment partners that add credence to young fledgling startups that are looking to establish themselves and really have to prove that they can get a top name involved. And indeed, many of these shadow investors are top names that adds a lot of credibility and indeed future fundraising rounds that they're able to anchor. They're able to drive thematic, long-term investing in many countries in this region that other investors might feel are not ready for investment, many sectors that take quite a long time to mature in terms of their return, the deep J curves that I've mentioned previously. And they also raise the bar for talent models in Southeast Asia and globally as well. And so, as I mentioned earlier, fund managers are the ones that have to respond here. But just as other sectors are being accelerated in terms of the secular trends that we have seen in these markets, people were already shopping online. And I think we'll continue to see that they're shopping online and And as a result, fund managers just have to get better at really focusing on their sweet spot, their differentiated capability, and so on. Our report's online. It's been a real pleasure, so thank you for tuning in. Our emails are in here as well.
Thank you, Alex and Suvir, for explaining investment trends in Southeast Asia to us and also helping us understand why shadow capital is growing in popularity in this region.